Okay, support material 3 actually. Okay, so just to recap one thing from last week. Last week we spoke about a forward. Okay, remember a forward is what?
Forward is a price, okay, a contract agreed today on a price today.
Okay, but give me the characteristics. Is a forward OTC or exchange traded? Okay, why is it OTC?
Because it's not regulated and specialized.
Good. No regulation. Specialized. Good.
And
default risk, yes or no?
risk, yes.
Default risk.
What else?
Is there
It's not a huge market.
yes, okay. In terms of the forward, well, the market's actually very large, but it's not regulated in terms of there's no clearinghouse. Okay, they're not standardized contracts. Okay, good. Right, so when we look at derivatives, obviously we're splitting derivatives into two groups: the forward commitments, the contingent claims. Okay, and if I look at forwards, they fall under the OTC. Today we're looking at the futures, which fall under the exchange traded. Okay, so now here we will have a clearinghouse. Here we will have no, or let's say reduced default risk. Okay, not to say exchanges are totally default free, but there's a less risk of default because there's someone in the middle that's going to be settling that particular contract. Okay. All right. The next bit we need to look at is the introduction. What is a futures contract? A futures contract is what?
A futures contract is the same as a forward.
Exactly.
It's on ETC.
Yeah. So it's the complete opposite of a forward, but it also relates to future delivery, okay, of a product or good, or the future exchange of cash, funds, or whatever the case might be. All right, so okay, before I show that, okay, let's just highlight this. Are futures contracts more risky? No. Okay, they carry less risk because of this JSE. Okay, so there's an added level of protection that investors would have, okay, in terms of engaging in derivative products without having the need, or let's say without having the risk of default. Okay, you want to try to keep your risks as low as possible, and one way of doing that would be looking at regulation. Okay, so there's the note about futures versus forwards. Okay, last week we focused on this. Okay, this week we're obviously focusing on this, the NB. Okay, so we'll look at futures, and you'll see futures and forwards are actually identical. Even the valuations are quite similar. The only thing different with a future than a forward is this, the mark to market. Okay, so you'll see this is a consideration in terms of margin. Okay, we spoke about margin last week a little bit in terms of keeping a certain amount of capital available. Okay, like Basel for banks, they have to keep capital for deposits. Okay, same thing happens here. If you're depositing money with a broker, the broker is going to want you to keep a margin. Okay, right. The biggest difference is obviously the mark-to-market, i.e. the clearinghouse. Okay, that was what's applicable here, which isn't applicable to a forward. There's no clearinghouse for a forward. Okay, so mark-to-market gets done by an external third party, which is unbiased. Okay, so the third party doesn't care who's profitable, who's unprofitable. They're just there to add liquidity to the market. Okay, so clearing houses also add liquidity. Okay, because I have a clearing house or an exchange, okay, the exchange normally acts or provides that particular service, okay, in terms of settling transactions, okay, marking transactions to markets, okay.
Just so quick,
Sure.
No,
go for it.
I just want to check my understanding of mark to market.
Yeah.
Comes up in the NB too.
Yes.
Mark to market is when they take the spot price. Let's say I've got a contract that's set up 30 days ago, right? And a mark to market spot.
Yeah, every day it will get marked to market. Yeah.
Okay, forwards.
It's a future.
Yeah. So then what I would do is that contract would be repriced today at the current spot price.
No, it wouldn't be repriced. The contract will have a price.
But then
the contract will have a price.
The asset is what's repriced?
What's repriced? Nothing's repriced. All they've looked at is they've compared the actual value. So when you bought the contract, what was the underlying asset that you bought? It might have been gold, it might have been currency, it could have been interest rates, it could have been anything, right?
Yeah.
So when you took out the contract, let's say I took out a contract on gold when gold was at $1,000 an ounce, okay? Now, let's say a day later, okay, gold is now $1,001. Okay, so the $1 difference is the mark to market, because now the contract will either have increased or decreased in value based on the underlying. So there's no repricing of anything. It's just putting the one part. It's almost like it's like
back to square one.
basically it's like saying, okay, so you took out the contract, your speculation was correct in terms of maybe a rising let's say in the gold price rising, i.e. a $1 gain in the gold price. So your contract now would be viewed as being more valuable, right? So now you don't want this contract to now rise and rise and rise. What happens? Let's say this gold contract is for a period of a year. Okay, at the beginning of the year, gold is at 1,000. Okay, 2, 3, 4 days, gold is roughly $1,005. Okay, do you agree in terms of the future delivery of that contract? So if someone was supplying the gold, right, for them to supply gold at 105 or 1,005 isn't going to put them out of business compared to $1,000, right? Okay, but if gold had to continue to rise, and let's say over the year gold was 1,000, now it's sitting at 1,300. Okay, now there's a risk of default because the party that's supposed to deliver or meet their promise might not do it because their position is so out of favor. Okay, and that's why it's mark to market. So every single day you're basically saying, well, today you made a profit, so now that person would then pay over a certain amount to the other. Okay, and that continues until the contract actually expires. Yeah. Okay, that's pretty much what's happening, and that gets done by the
clearinghouse.
yes. Okay, well, yeah, because they're acting as the intermediary. Okay, because individual A wants the future, individual B wants to issue it. So the one has the product, and that's the contract they've both entered. It's two sides of the transaction. It's just someone in the middle to make sure that everyone is happy and doing what they said they were going to do in terms of the contracts. Okay, so that's pretty much what's happening. Okay, so there's the definition of a future. Okay, you'll see it's pretty much identical to what we saw previously. Okay, for a forward. The only thing here is, does it look similar, familiar? Yes, it's a forward. Okay, if it's a forward, we know the underlying is key. Okay, the underlying asset is important. Okay, futures are forwards that are standardized. That's it. Okay, so when we talk about futures and forwards, they're pretty much the same thing. Even the valuation is very similar. Some of the equations you'll see here are literally copy-paste from forwards. Okay, purely because there's not much different. There isn't a lot of differences with each of these because they're both going to be doing the same thing. Okay, delivering something in the future. Okay. Right, so better oversight or regulation, reported on an exchange, a clearinghouse assists with the delivery, okay, and it's subject to regulation. Okay, so not all futures, okay, can be listed. Right, if a future isn't listed on the exchange, then what is it called? A forward. Yeah, an unlisted future is a forward. Okay, a forward that is listed would be a future, basically. Okay, they're the same thing, basically. Okay, there's nothing different really with the two. Okay, there are contracts, there's an underlying asset, and there's some sort of future delivery. Okay. Is that alright? Okay. There's the note about homogenization. Okay. This is looking at standardized contracts, okay, on a traded exchange. Okay, so obviously we spoke about liquidity. Okay, if things are standardized, Do they become more or less popular? They become more popular. Okay, and that's why if we look at car manufacturers, right? Henry Ford was the first person who created the Model T, all right, the Model T vehicle in the US, okay, USA, right? And what did they do? They made the car easy to produce. Okay, so now before cars used to be handmade, built from scratch. Now there's a production line where you've got different components that are done ahead of time, and that reduced the value of the vehicle, and now everyone can own a vehicle because the cost of production has decreased so much. Okay, that's what homogenization is. Okay, homogenization, I think that's how you say it. Okay, homogenization. Okay, standardizing contracts. Pardon?
Any color as long as it's black.
Yes, that's right. Exactly. Correct. Yeah, because painting cars different colors adds cost to the production. Yes, and it might create delays as well and so on. Very good. Yeah.
I just remember Rob telling us that.
Oh, okay. That was also okay. It might account operations as well. It was probably a case study even.
Yeah, it was.
Yeah.
Operations production management.
Nice. Okay. And then a clearinghouse, that's the daily settlement, and performance is guaranteed. Okay, because there's a middle person or middle intermediary or bank, or in this case a JSE, that'll then mark to market those contracts. What are they? They're paper gains. Okay, so you're not physically holding those assets. You're just holding the contract. Okay, so I'm gonna again talk about the CFDs. Okay, because CFDs are exactly that. They're futures. They're future contracts. Contracts for difference. Okay, CFDs are regulated contracts because it's an exchange, and because they're futures, there's marked to market, so there is lots of liquidity and there's no default risk. Okay, purely because gains and losses are converted to cash daily, right? And it's normally called funding. Okay, so on a platform, you'll see a funding cost that's attached to your account that would basically come off every single day. Okay, obviously at the close of the business day, depending on the type of the provider. Where's the provider situated? Okay, but it's a funding cost. Okay, and the funding cost is based on your open positions. Okay, so you don't get marked to market on positions that are pending, okay, or on market orders. Okay, remember we spoke about market orders, limit orders, and those types of things? Okay, orders don't carry mark to market, okay, i.e. there's no paper gain or loss. It's only open positions. So only open positions will have a funding type of cost, i.e. the mark to market. Alright, there's a note about futures trading. Okay, standard contracts can be easily traded on an exchange. Great opportunity exists. Why? Again, in terms of asset management, we know contracts offer opportunity in terms of strategy. Okay, so you can structure a position based on derivatives. Okay, we can use derivatives to either add risk or try remove risk from a particular transaction. Okay, right, so there's a clearinghouse, there's margins, and there's price limits. Those are three things that you should be familiar with. Okay, so a clearinghouse would be what? JSE clearinghouse, let's check it quick. Yeah, clearinghouse. Futures exchange, no.
Oh, but this is an American textbook, I won't have it.
Yeah, they won't have it, but they should talk about the... It should just be... It's a clearinghouse. Let's check. Does it have a name?
I think so. I
can't think of it now.
Unless I'm imagining, but I seem
Let's
to
check.
remember that I studied the markets.
Okay, there's a different module.
Straight.
Alright, let's see. JSE clearinghouse. Oh, okay, now hold on a sec.
Sorry, now
JSE.
really going off.
JSE clearing house. JSE clearing house. It just says JSE Clearinghouse. World Swiss Clearinghouse margin, South African Futures Exchange, RMB. No, I'm just I'm literally just Google JSE Clearinghouse, and
Nothing comes up.
for me, the JSE would be the clearinghouse.
Why do I seem to think they've got a different?
I'm also finding it quite unusual.
I know that.
You mentioned it, but I don't think so. JSE Clear, formerly known as SAFCOM, a wholly owned subsidiary of JSE.
There we go, SAFCOM, that's it.
But that was formerly known as. So.
I studied it in the South African market.
Serious?
Yeah, a couple of years ago.
Okay, but yeah, that's why when you're saying it, I'm like, okay,
What is wrong?
yeah, because the JSE is the clearinghouse. The JSE is it, but it's a subsidiary of the JSE. So the JSE is the clearinghouse. Before it used to be separate. Yeah, but now it's part of the JSE. Yeah, so JSE, it's called JSE Clear. Okay, brackets, formerly known as SAFCOM, a wholly owned subsidiary of the JSE, is the clearinghouse for all exchange traded derivatives in South Africa. Okay, and that's from the JSE website. Yeah, okay, so I think maybe that's what you're referring to, SAFCOM. Yeah, but that's historical information.
Yes.
Yeah. Okay, but that's the memory. That's good. Okay. It's general knowledge. That's good. Now you can say SAFCOM was the clearinghouse of the JSE in the past. Okay, that's it's what do they call that? General knowledge, but it's interesting, useless information.
Yes, exactly.
Okay.
Like I'll never get straight.
Straight, okay.
Straight is the system that they run. It's a clearance.
Okay. Yeah, but that's still used though.
Yeah,
that's still part of the cost, like the straight cost in that. Yeah. Okay. Well, what is the margin?
The difference.
No, not the difference.
Well,
The margin
what
is
you have to put in to
okay.
maintain your position.
Yeah, the margin is the deposit. It's the capital that's available that allows you to hold a position. Yeah, so no platform is going to allow you to hold a position if there's no guarantee in the form of a deposit. Okay, it's like no bank in South Africa would be able to loan money, okay, if they didn't have deposits. Okay. All right, and price limits. Well, that could be something you could consider. Yeah, price limit would be like a margin call, perhaps. Okay, so what would be the maximum that you could have in terms of price where you would avoid being, let's say, margin called, okay, on your particular account? Okay, that's the risk management side of things. Okay, then using leverage can maximize both profits and losses. Okay, we spoke a bit about margin calling last week. A margin call is when you have to deposit more to top up your fund or your account, okay, to fund the account in order to meet the minimum requirements, okay, because your position might be out of favor. Okay. Right. There's another note about the futures contract. Okay, again, it's identical to a forward. Okay, the most important thing here is the delivery and the settlement. Okay, they refer to it as futures closeout. Okay, I don't know if I've mentioned this before to you. I know I've spoken about it in one of my lectures. I can't remember which one, but does that ring any bell? Futures closeout. No, okay, so then I probably haven't mentioned it to you specifically in terms of, but this is a news type of event, and it's almost like a catalyst because it happens normally on a Thursday, okay, and it normally happens at the end, okay, of a period. So like a quarter would be maybe futures closeout because those contracts. It could have been. Okay, maybe it was then. Okay, but that futures closeout would have been almost like a catalyst because the market would react, okay, to those contracts being closed out. Okay, and when those contracts are being closed, obviously there's settlement or delivery. Okay, so there's normally added volatility during that particular, let's say, news announcement. Okay, when futures close. Okay, futures close out. Yeah, normally a Thursday. You normally, like, if you listen to the news or radio or any business show, it's normally on a Thursday you'll hear them talk about a futures closeout. Okay, but again, it depends on the type of contract. Okay, but normally on a Thursday, you normally hear that note or that announcement. It's like a Friday is normally non-farm. A futures closeout is normally like Thursday. Okay. Right, and then closeout, i.e. the contract is sold, okay, or settled. And there's physical delivery or payment, okay, of the underlying asset. Okay, obviously we know contracts only get, let's say, settled, i.e. the transaction actually goes through at the end of the contract when it expires. And that's why when futures close, what's happening? Yes. Okay. People are going to have to settle positions, deliver shares or cash settlement, whatever, commodities. It could be anything. Okay, but that's the physical delivery. All right, and that adds more volatility. Okay, in terms of the market. Okay, the market normally reacts around that time of the let's say period of the year. Okay. Right, the next bit, a market where buyers and sellers trade futures is a futures exchange. Okay, we know an exchange is regulated. Okay, and there's a nice list of exchanges, okay, on page 95 of the textbook. Okay, you'll see they've given you a list here, right, of the world's 20 leading futures exchanges. Okay, no, you don't. It's just for interest. Okay, so obviously you probably would have gone through it maybe. Not yet, okay, but yeah, that was quite interesting to read in terms of if you look at the world's leading futures exchange, okay, they're all based in first world countries. Why first world countries? Yeah, why are all or most of the futures, okay, in first world countries? Besides the technology, the banking sector, the financial sector. Right, so the financial sector is more sophisticated. Right, remember what happens? Emerging markets, they're just looking at what? Loans and deposits. Right, there's no time, okay, because there's no need or demand for other financial products. Okay, but when those deposits and loans have reached their, let's say, maturity in terms of product life cycle, okay, then you start creating other fancy products. Okay, and that's why Germany, Switzerland, US, UK, right, those are big, okay, futures exchanges in the world. Okay, compared to others. I mean, look at South Africa compared to Germany. Okay, in terms of volume or number of contracts. Okay, this was obviously a bit outdated. This was from 2002 in terms of what we've got in the textbook. Okay, and that was around 12 million contracts. Okay, compared to Germany and Switzerland, right, 435 million contracts. Okay, it's a lot. Right, obviously, why do those types of places or let's say regions have more contracts? It's because of the products. Okay, they generate the products. You can create the products. All right, future contracts can exist for many underlying assets. So you get futures contracts for commodities, you get future contracts for interest rates, equities, currencies, indexes, okay, i.e. indices. Okay, what is an index? Yeah, exactly. It's a portfolio of assets. Okay, so top 40 would be an index. Okay, the NASDAQ would be an index. The JSE is an index. JSE Aussie. Okay, that's an index. Okay, the FTSE, okay, is an index. Okay, those are all different indices, okay, that represent a collection of assets. All right, so now let's have a look at interest rate futures. Okay, what is an interest rate? Okay, good. So it's on debt, right? On short-term money market instruments. Okay, so interest rates would be payable on savings or deposits. Okay, and same thing with loans. Okay, so treasury bill futures. Okay, a treasury bill is a risk-free asset issued by the government, right? Okay, so when looking at pricing, okay, what are we going to be doing? What is the difference between pricing and value? Do you remember?
Pricing is what the market is currently saying. Sells for what you can buy.
When?
Now.
No.
Or currently.
No, value. Pricing is referring to
Pricing is what the
future. Pricing.
Yeah.
That's the future. Value is now. What you value the contract at.
And pricing what the market is offering.
No, okay. I think you're thinking. Yeah, you're thinking about other things as well in terms of the market price. So the market price is what? Today's quoted price in terms of buyer and seller. Okay, so a valuation. So an expected price would be what? It would be a valuation what you believe you should buy it for, and pricing is what? Pricing for it. No, pricing for it would be leading to the future. Okay, because I'm going to price what is the futures price? So when we talk about the futures price, that's a good example. What is the futures price looking at? Is it the price today or is it the price in the future?
For the future.
Okay, all right, I see. Okay, so you're talking about today, but the price is referring to the future. That's the important bit. Okay, so the pricing is there, the future. Okay, but
it's set today.
Well, it's not set today, but it's based on today's information. Sure. Okay, yes. Okay, we're on the same page.
We are on the same page.
Yes, we are. Okay. Yeah, I think you were just looking at it more from like now, and I was looking at it more from there. Okay, because the contract will be exercised at that point in time. Okay, so that would be the future price. Okay. Yes. Okay. All right. So the futures price for a treasury bill would be the principal times the 1 minus the rate. Okay. If I minus the rate, what am I doing? I'm basically discounting. Exactly. Okay. So if I'm calculating the futures price for a 90-day 1 million treasury bill, what would the answer be? For 90 days. Correct. Okay. So the futures price would be 985,625. Okay, that's the futures price based on today's information. Yeah, 360 is it's to avoid the 1 day. Yeah. Yeah, that's the futures price. Okay. All right. There's a note about value or price today. Okay, so spot is what? Today. Futures price is what?
The future price today.
The future price today. Okay, yeah, okay. And then the value of the future is what? Yes, the actual derivative. Yeah, that's the derivative's value. Okay, good. Okay, so NB, value of the futures contract at initiation is 0. Why is it 0? It was mentioned also in forwards. It's to avoid. Exactly. Okay. All right. So mark to market is effectively bringing the value of the future back to 0. Why? Because you're settling each of those parties' positions. Okay. Position A and B. Okay. You're settling the one from the other. Okay. All right, so marking to market eliminates default risk. Why? Okay, and remember, it's a smaller position to settle. The longer you leave the derivative, right, the more risky in terms of. So, for example, would an option? Okay, we'll talk about options later. Well, if a contract has a longer term rather than a shorter term, which contract would be better? From the point of view of the investor. So would an investor want a contract with a longer term or a contract with a shorter term? What does the term do?
Term do as volatility as a uncertainty.
Okay, good.
I understand that. I'm just trying to think.
So that's why with the default risk, if you're marking to market, okay, these transactions and you're doing it daily, okay, what risk do we have if it's marked daily? No risk for the day. But what happens during the day? It changes. So could you mark to market it more regularly? Could you mark to market hourly? You could if you wanted to. Okay, because this is looking at default risk. Okay, so prices can change. Right, if you're marking to market yearly, what risk are you putting in terms of default risk? A higher risk. Okay, so if the term is slightly longer for a contract, it actually adds more default risk because one party might not do what they said they'll do on that particular contract. Okay. Right. And futures are essentially free of this risk. Why? Because they don't wait, okay, for the end. They mark it to market every single day, yes. Okay. Right, so valuation, futures price equals the spot price taken forward. Remember, this is your compound interest formula. Right, so if I'm taking my spot price forward, it should be equal. There shouldn't be any arbitrage. Okay, so what would the futures price be for an underlying asset in 180 days with a current interest rate of 5.5? Okay, so what should be 100? The futures price?
Sorry, it should be spot price.
What? Yeah, well, this is what would the futures price be?
So you'd have to calculate. You'd have to take 100 times by 1 plus 5.5%.
Yes.
180 days.
Correct. Good. Okay, divide by 365 because I'm compounding it forward. Okay, so again, that's what? That's pricing. Okay, pricing. I'm trying to price the contract today based on what's going to happen in the next few days. Okay, 180 days.
So you would pay?
No, you wouldn't pay. The contract would be created with a futures price of 102.
And then so in 180 days, you would pay 102 for an asset that is currently selling for.
Exactly. Yeah. Okay, good.
Sorry.
Nice. Okay, good.
I'm just trying to get it.
Yeah, it's right. Okay. Right, so if there are storage costs, pricing of the future would include the future value of storage costs over the life of the contract. Okay, so holding gold, holding corn, holding soya beans, coffee, cocoa, milk, etc. Okay, all those underlying costs have storage costs. Okay, because you need to put these somewhere. Okay. Okay.
What's the storage cost?
Which assignment? Which one? The third one? The second one?
No, this first
Oh, the first one. Okay, yeah.
There's one with the net carrying cost.
Okay.
Because you're going forward in time, you calculate the future value of the storage costs and then add them, or you just add the current?
Okay, it needs to include the cost. So if it includes the costs, because the cost would be the cost that it would the cost that would be incurred by keeping that underlying asset, because future delivery. So you would have to include the storage costs for that particular asset in the future. Yeah, so you would have to add it to the value or the forward price.
So you add it to the forward price, but then you first, before you add it to the forward price, you calculate for the future value before you add it, or do you just add that?
It would have to include it, so it would have to include it. I would put it in. It would have to include it. So if there are storage costs, you'd have to include it. Yeah, so it would be included. Oh, okay, so what you're trying to say is, okay, so you have spot, you have the rate. So now, do I add on the cost now and then take it forward? Or do I take it forward and then add the cost? Okay, you would have to take it forward with the costs, because the costs are part of the actual underlying asset. Okay, and it's the cost today. Unless you had the cost in 5 years' time, you wouldn't be able to add that to the end future price. Yeah. So you'd have to take the information you know today and you'd have to project it forward. Okay, yeah.
Because I didn't do that with question.
Okay. We'll check. Yeah, we'll check it. Okay. All right. And there's the note we spoke about last week. So we ended last week with the theory question. There's your note. Backwardation and contango. Okay. These two seem to come up quite often. Okay. And that's why there was a note on it here on the slide. Okay. So backwardation, right, is looking at the futures price, right, being less than the spot. Okay. And contango is when the futures price is more than the spot. Okay, remember, there's the diagram. Okay, this is T0, which is spot. Okay, this would be the expiration of the contract. Okay, and maturity could be longer than that, yeah, in terms of what the underlying asset has. Is that okay? Okay. All right, so here's a note about T-bills. Okay, find value based on spot prices. Okay, so here's the formula. Okay, future 0 means today. Okay, and H is the correct. There's the H, expiration. Okay, all right. So a futures contract on a T-bill expires in 50 days. Okay, so when is the contract going to expire? Alright, so if we had to draw a diagram, this would be T0 and this would be T 50 days from today. Right? Okay, the underlying asset matures in 140. Where is that? That's at the end. Okay, so notice how you're making a contract based on a underlying asset. Now, what is the underlying asset? The treasury bill. And the treasury bill is maturing in 140 days. Okay, you're looking at a futures contract. Remember, futures or derivatives can only exist if the underlying asset exists. Do you agree? So when this T-bill matures, what happens to the contract? It doesn't exist. Okay, because the contract only exists because there's an underlying asset. When the asset is no longer there, the derivative is no longer there. Okay, that's like those. That's like the crisis. Okay, when the underlying loans went bad, all the other loans were bad. Okay, there's no underlying asset, so they're actually worth nothing. Okay, it's like a chain effect. Okay. All right, spot discount rates are 5%. Okay, 50-day. That's the 50-day rate, and the 4,6 is the 140-day rate. Okay, so you've got two rates there. Those are the spot rates for the 550, which is the 5%, and the 140, which is the 4.6. Okay, so you've got two rates because this is a treasury bill. Okay, so there will be spot prices in the market. Okay, so what would the futures price be? Well, there's the scenario. Okay, if I look at the first option and I look at the second option, this is 50. And that's the 140. Okay, so 50 days and 140 days. Right, remember it's a treasury bill, so I'm looking at discounting interest. Okay, so if I work this out, okay, for the 50 day I get that, and for the 140 I get that. The difference would be, not the difference, right, the one divided by the other gives you the futures price. Okay, because if I look at the top and the bottom, okay, it's the longer, there's the longer rate. Okay, which is what? The 140 days. Okay, so it's basically the 140 days over the 50 days, exactly, and that gives you the price. Okay. What about this one? Have a look at the formula. Right, B0, H plus M, okay, which is maturity, that's the total. Okay, what is that representing? Compound interest, because that's a positive exponent. Okay, so the example here, a futures contract on a bill expires in 50 days, underlying asset matures in 140. The spot discount rate is 5% and 4.6. Right, now we're calculating the futures price using the spot, compounded at the appropriate risk-free rate. Okay, all right, so what am I doing? I'm taking one amount today and I'm moving it forward. Okay, this is just a simple TVM type of calculation. Time value of money. I'm taking one amount today and I'm compounding, not compounding it, but how can I say, forecasting it into the future. Okay. We're taking the 140 day forward. No, yes, yeah.
So 0.9821 is the future price
because it's risk-free. Calculate the future spot using the underlying appropriate risk-free rate.
So you'd have first to the prior calculation.
Yeah, so the first bit, here's the chair. Here's the 98,
Yeah.
21.
Get that, and then take the 50-day risk-free rate, which is 5%, and then
The compounding. Yeah. Okay. All right, the next one. A future contract on a treasury bill. This one is, okay, this is the implied discount rate. Okay, so there's the formula, right, to work out the rates. Okay, if it's implied, what does that mean? It's an implied, what does implied rate mean? Try. Think about IRR.
Yeah, it's through the pricing and valuation that you apply on the rates.
Okay. Yes, it does. Okay, so think about it. Remember, what are we doing today?
Pricing for the future. And then in the future we'll have a price, and we'll get the applied rate and how will it happen.
Exactly. There you go. Because implied means based on what we've got currently. So what we have in the future and what we have now. Okay, because remember, this was the, where was it? Here. This was the, what does this represent?
That's the rate today.
Okay, yes. Okay, because this was a 140-day treasury bill. Right. And what does this mean? It means take that amount and now move it forward. Okay? 50 days, because the treasury bill will expire in 50 days. Okay, the implied rate is not implied rate. This is the futures price. This is the implied rate. Okay, the implied rate is the difference between the value of the underlying asset.
So this one on slide 15, the futures price is 1.98. Should be the same as the futures price on slide 60. Is that right? That 0.8.
Yes. This one.
Yeah, that one. Should be the same as when we use.
Okay, what is this price? This is the price today. Okay, what is this price?
That is.
Oh, not that price, this price.
That is today's price.
This is the futures price. No, this is compounded to time 50.
Yeah.
Okay,
From
so
T0.
This is from T0. Yes, from T0.
So it should be the same.
Okay, it should be. No, it shouldn't be the same. Okay, because this is the futures price using the underlying risk-free rates.
Oh, that's the average risk-free rate.
Okay.
Versus the.
Right, this is the implied discount rates.
Okay, right.
Okay, so we're looking at taking something forward to get the futures price. Remember, the futures price is pricing based on today's information. Okay, that's based on today and what we'll have in the future. The implied rate is looking at now, okay, that's what I have in the future, and this is what I have today. What is the actual implied rate? Yes. Okay. All right. So it's looking at this. It's looking at the futures price and comparing it to, okay, the number of days in the scenario. Okay. So what did I do? I had the asset for how long? T0, T50.
And then another 90 days on top of that until it's time.
Correct.
You're sitting at T1.
Okay, so we're looking at this.
That section where we've already priced that section.
This shouldn't be 90. What should this be?
That should be T140.
140, yes. Okay, the difference is 90, correct. Okay, 90 is the difference.
So we priced the 50 days. Now we're looking at the applied rate from 50 days to 140.
To maturity.
90 days.
Okay, to the end of the contract. Yes.
So what is that 4.44?
The 4.44 tells you the implied rate from here to there is 4.44%. Okay.
If I then have, so then if I look at the 140 day rate, which is 4.6, can I do that comparison? Can I say?
No, you can't, because that's the rate for 140 days.
Oh, yes, sorry.
The implied rate is for 90 days.
So you get a 90-day rate and you would compare
you could possibly compare this to a 90-day rate in terms of what's implied in this contract. Okay. Right, then we've got a note about bond futures. Okay, if I'm looking at bonds, what do bonds pay? Coupons. Okay, that's why you've got this here. CI. What does CI stand for? Compound interest. Yeah. Okay. Not compound interest. Coupon interest. Yes. Okay. All right. So the example here: calculate the futures price of a 3-year R1 par treasury bond with a 7.5% yield. Okay, 7.5% represents what of the bond? The I. 8% semi-annual coupons. How do we get the payment? Divided by 2, correct. Okay, the current price is that, and the once-free risk rate is 7%. Okay, what must I first do? I need to work out this. The future value of all of my interest payments when? At the end. Okay, time expiry, basically. Yeah. So if I look at this, what am I looking at? What time frame? 12 months, 1 year, correct. Okay, so if I look at the future value of the interest, I'm going to get this. Okay, that's the future value of the interest. Right, the futures price is what? You've got the current price. Just compound it for 1 year. Because that's the difference. Okay, the difference would be what the contract would be worth. Okay, right. So therefore, the price of the bond future expiring at time H is the difference. Okay, the 10026. Okay, is that right? Okay, right. Here are a few other formulas. Okay, other notes here in terms of stock evaluation. Right, and here there's an example looking at calculating the futures price of a stock index. So again, futures price of a stock's index. So what are we looking at? Future price. Okay, it's currently 755.42, which expires in 57 days. The risk-free rate is 6.5, and the future value of the dividend is 3.9. Okay, so what must I do?
Well, we don't need to calculate the future value of the dividend we've got. So now we just need to go back to
exactly. Okay, so this is what? The spot that I'm taking forward right up until the date of expiration. 57 over 365. Okay, minus the dividend of 3.40. Why do I subtract the dividend? Okay, it's the future price. Okay. It would be priced at the current share value, yes. Okay. Right, then on your next slide, you've got a note about currency futures. Okay, so those are the equations that you would use for currency futures. Okay. Right, calculate the futures price for the Swiss franc, currently trading at that. Right, the US dollar is 6 and the Swiss franc's rate is 5. Okay, the currency future expires in 180 days. Okay, so what must I do? Well, I'm looking at what? Expiry. Okay, because I'm calculating what? Futures price. Okay, so futures price relates to the future based on today's information. Okay, so based on today's information, what is this asset worth?
1.6. Well, in the market, spot price.
Yes. Okay, so 0.6 is the current price in the market, correct. If I divide it by, what am I doing? I'm taking it forward or backwards? No, divide by, a divide is a times. Okay, so here you would be taking it backwards. Okay, 78 days. Right. And then taking it forward. Okay, to work out the future price. Okay, because we first need to know what the price is today before we can work out what the price is in the future. Okay. Right, and remember the only thing that we had here was $60. Okay. Right. Are those formulas any different? They're the same. Okay, why? Oh, I think I've actually copied. Oh, there's the difference. Right, continuous compounding. Did you see that? Okay, so in this example, did I use continuous compounding here? No. Did I use continuous compounding there? Yes. Okay.
So which one is specific? That's triple continuous compounding.
Continuous compounding, just look for the E. Continuous or something, I don't know. Think of a way to remember it.
Would
Okay.
they tell us to use continuous compounding?
Well, they need to in the question because you won't have the solution. You won't have the working.
That's what I was, because that's what I kept looking for an example. Like,
Yeah.
they
So
don't-
only use continuous compounding if there is continuous compounding.
So they would say, based on continuous compounding, they would lead you.
Based on continuous compounding, price to forward.
Yeah, okay, so they have to lead you. They can't just.
Yeah, they have to tell you that you need to look at continuous compounding.
Because
Yeah.
I mean, they give you the same numbers regardless of what you use. And I think now which one?
Yes. Yeah. They need to be specific. Yeah. Okay, and then that wraps up the futures.